I am an executive financial advisor with Old Mutual. I've been with Old Mutual for 28 years, and I've now been joined in my practice by my daughter Kaylee, who is doing the slides, etc., and helping me in my practice. Right, so now let's just get going. Two-part systems. Firstly, the proposed implementation date is the 1st of September. And I think they're going to stick to that. It has been moved several times. It's going back right to 2021. It's taken them 3 years to sort this out because it's very, very complex. And the legislation isn't finalized yet. There are many complexities that may arise in the future that we have not yet predicted, and which that may require extra legislation to be introduced to cover those particular problems. Okay, thanks. This is us, that's me, and that's Kaylee. And there are our email addresses, vmog@oldmutual.com, and Kaylee is cmog@oldmutual.com. And we have a special dedicated WhatsApp or phone number, 0725867862, which is just for business purposes. Right. Firstly, what do we do as financial coaches? What we do is we educate and guide our clients to make good financial decisions. And here, for instance, is an example. I know it's quite small, but what I want you to look at is we show clients the consequences of their financial decisions. So this, for instance, shows you what it costs you to draw. If you draw 10,000, as we will see later in the presentation, you're going to be able to draw money out of your pension. What is it going to actually cost you at retirement having drawn 10,000 Rand? And that is based on a marginal tax rate of 31%, an admin fee of 400 Rands. I don't know how much the admin fee is going to be. Different products will probably have different admin fees, and an investment return in your pension of 8%. So you draw 10,000 Rands when you're young over here, and it can cost you 300,000 Rands when you come to retire. And at this stage, I'd just like to say, if you want to ask a question or make a comment, etc., please just put up your hand and put on your mic, unmute yourself. That, for those of you who are unfamiliar, is a button towards the top right-hand side of your screen. It says mic. You can turn that on, and raise your hand is almost in the middle at the top. There's a little picture of a hand. Okay, Kaylee, can we have the next slide? Now, in order to understand the changes, we first need to look at the existing situation. First of all, when can money be taken out of your fund at the moment? Now, when I talk about your fund, I mean your pension fund, your provident fund, your preservation fund, or your retirement annuities. Firstly, if you die, so if you die, your dependents, and dependents is in inverted commas because there is a legal definition of that, your dependents will be given access to your money. And often the fund will have risk cover in addition to whatever you've accumulated in your pension. And so your dependents would benefit from that risk cover in addition to that. So, for instance, most pension funds have, for instance, let's say 2 or 3 times annual salary as the risk cover, and that would then be added to whatever you've accumulated thus far in your fund, and the dependents would have access to that. And they have a variety of different ways they can take it. They could take it as a lump sum after tax. They could take it tax-free into an annuity that generates an income. The income will be taxable, but the transfer of the capital is tax-free. There are a variety of different ways of them actually accessing the money on your death. And that too is a complex decision to make, and therefore you really need financial advice before you embark on a decision of that nature. Okay, can we see the next time we can have money? Okay, the next time you're allowed to access your funds is if you are disabled. Remember, the principle behind a pension, any of these pension funds, is to provide an income for you when you are no longer able to generate an income for yourself. So if you're dead, obviously you can't generate an income for your family, so that's why they get access to your funds. If you're disabled, you also are not capable of generating an income, and therefore you're going to be given access to those funds to give you an income in your disability. And also many funds, now this doesn't apply to retirement annuities. Well, certainly the modern retirement annuities. Modern retirement annuities don't have any risk cover attached to them, but most pension and provident funds do have risk cover attached to them. And it could provide disability payments of up to 90% of your salary until age 65. The pension funds that I've done for our clients, I normally try to get them to accept that as one of the benefits. It costs very little, in fact, and it means that if one of the employees is disabled, they will continue to get 90% of their salary until retirement age, whatever the retirement age on that particular fund is. So that's the second occasion on which you can access your funds if you are disabled. Now, the third one, and this is the one that really the two-pot system is aimed at. If you cease to work for your current employer, in other words, you are retrenched, you are dismissed, or you resign, then you are allowed to cash in all or part of your accumulated credit. And this, up until now, has generally been the case. Most South Africans are expected to work for at least 4 or 5, or have 4 or 5 different jobs during the course of their working life. And certainly on the first 1, 2, maybe 3 jobs that they're in, they tend to take all their money. And so when they come to retire, often they've only been with the final employer where they're accumulating a pension for 10 or 15 years, and that's really not long enough to accumulate sufficient to retire. Okay, so you could cash in your pension or provident fund, and it's subject to tax. So we'll see the tax tables in a moment, but not just yet, Katie. And then the other thing you could do was to transfer tax-free all or part of your accumulated credit to your retirement annuity, a preservation fund, or your new employer's retirement fund. So you could access the money, but actually preserve it for your retirement. But very, very few people actually did this. I've got one very good client, a young man in his 30s. He has done this every single time he changed jobs, and he now has 1.5 million already in preservation funds, so that he can. I mean, that's going to grow to several million by the time he comes to retire. So, but he's virtually unique. I don't have other clients who've done that. Most of them take the money and run, which is a pity. Right, okay, now let's look at, okay, and then the third occasion on which you're allowed to take your funds is if you retire from the fund. And the rule is that you cannot retire if you are younger than 55. So you need to be 55 before you can retire. Retirement ages of 65, etc., are merely fund specific. So a particular company's retirement fund may say, okay, you retire at 65, but in order to comply with the law, you only have to be over 55. And at 55, you can take some or all of your accumulated credit subject to the retirement tax tables. Now, when I say all, you are only allowed to take all if you're in a provident fund. If you're in an RA or if you're in a pension fund, you are only allowed to take 1/3 as a lump sum. The other 2/3 has to buy you a pension. So that taking all at retirement only applies to people in provident funds. And again, there are tax implications. Right. So here are the current tax tables for withdrawal. So this is when you resign from your job, you dismissed, or you actually retrenched, uses the retirement tax tables as opposed to the withdrawal tax benefits. But Kelly, just move your cursor onto the naught tax. So only the first 27,500. Thanks, Kaylee. A nice yellow line across it. Only the first 27,500 in your life is tax-free. That's in your life. So if you resign from job one and you've got 50,000 there and you take the 50,000, that's your 27,500 gone for life. I'm doing this quickly in my head. The 22,500 will be taxed, Kaylee, at 18%. You see, that's the next step. So when you resign from your next job, it's not going to, you're going to get nothing tax-free. It's going to start at 18%. So it really, really cuts into your retirement savings by doing this. The tax does that. And also the opportunity cost, the fact that that money is not growing for you is really devastating. But unfortunately, this has been the case. This is what most people have done for the last 50 years. They've done that, paid the tax, and suffered a relatively miserable old age with too little money. Okay, so now let's look at the retirement. These are the tax tables at retirement, and you'll see they're much, much more generous. Kaylee's going to indicate the first 550,000 in your life is tax-free. So if, for instance, you want to take all your money and you because you're resigning from a job or something and you're over 55, you in fact should not withdraw. You should actually retire and try and get your hands on as much money as possible. Look, certainly if you're in a provident fund, you retire because you're going to get at least 550. Well, if you have that amount of money in your provident fund, at least the first 550,000 tax-free. If you're in a pension fund, maybe you don't do that because remember, you in a pension fund, you're only allowed 1/3 as a lump sum. So it's always preferable, if you can, to retire rather than to withdraw. There's certain circumstances under which you might withdraw despite the fact that you are entitled to a much better tax regime if you retire. I'll give you an example. One of my clients and her husband are planning to emigrate to Australia in about 2 years' time or 3 years' time, at which time she will be retiring from a pension fund. It would be nice if she could use these tax tables, the retirement tax tables. But the problem with that is that if she retires, then she's got to buy a South African pension. And she doesn't want to then immigrate to Australia and have a South African pension. So she's going to have to resign as opposed to retire, despite the fact that she's entitled to retire, pay much greater tax, but then at least have a lump sum that she can take with her to Australia. So again, that is why with any of these things, you need to get proper advice. I mean, I've been advising these clients, they've been working on immigrating to Australia for the last 5 years or so, And we have been advising them the whole way as to how to go about doing it. I'll give you an example. We actually stopped their retirement annuities just before they reached the de minimis amount so that they could actually draw the full amount out of their retirement annuities. We stopped that because we wanted them to have capital that they could take with them and not not be compelled to buy an annuity in South Africa. Okay, so that's the tax situation. I just want to ask now at this stage, any questions? This is the existing situation. Nobody seems to be, I don't see any raised hands, etc. Okay, Kaylee, can we go on to the next one? Okay, now how will things change from the 1st of September? Now, if you bear certain principles in mind, you can actually virtually answer any question of your own. The first principle is that legislation should not be retrospective, so existing rights will be preserved. Now, what that means is no law should change things in the past. So, in the past, you've had the right to take all your money if you resign. If you're in a provident fund, well, actually, that was also changed in 2021, but you could take most of your money in a provident fund, etc. And it's wrong for a new law to come in and say, bad luck, if you'd done it last month, you could have taken all your money, but this month you can't. So what's going to happen is they are going to preserve the rights you have with the money you have on the 31st of August. Kelly, we can go to the next thing. Okay, so your existing funds will be ring-fenced and treated according to the pre-two-pot regulations. So, in fact, two-pot is the wrong terminology for it, because it's actually, now you can see it's now a three-pot. And if you're in a provident fund, I won't go into the complexities of that. There's actually another pot for that, which makes it a four-pot, but let's worry about that. That's very complicated. So it means that you're going to have this amount of money that's accumulated up to the end of August, and that will be treated according to the old rules. You can take all your money if you resign. If you're in a provident fund, when you retire, all that capital can be taken and pay the tax, and you get a big fat lump sum. But okay, so that's the one thing. You must remember that your existing money will not be affected. The other thing to realize is that the legislators bore in mind when they drew up the legislation that people that are already 55 would have made plans for retirement, etc. And so if you were over 55 on the 1st of September 2024, when these regulations were supposed to come in, you are exempt from the two-pot system. But you can opt in. Opt in if you wish to access some funds but remain working. Don't opt in if you want to take all your funds at resignation or retirement in a provident fund. Only in a provident fund, not in an RA, not in a pension fund. So my advice for people over 55 on the 1st of September 24 would probably be not to opt in. Don't opt in, because you're going to see that what money you can have access to is very little. And anyway, you're going to be retiring quite soon. And you're going to have very little opportunity to actually draw money from your savings pot. Okay, so let's go on. Right. Now, from the 1st of September, all future contributions will be divided into two pots. So that's only money coming in after the 1st of September. Kelly, thank you. 1/3 will go into your savings pot. And this is the pot from which you can draw your funds. And very important, this is the pot that will provide your lump sum at retirement. Remember, at retirement, if you're in a pension fund or a retirement annuity, you can take 1/3 of your accumulated credit. And the first 550,000 is tax-free. So when we talk about lump sums at retirement, we are actually talking about, or often, well, hopefully, for your sake, we're talking about relatively large sums of money. So every month, 1/3 of your contributions are going to go into the savings pot. So you don't want to eat into that savings pot, or else you come to retirement and there's nothing. There's no lump sum for you at all. So there's no new car. There's no overseas cruise. There's no paying off the bond, and other things that people do with their lump sums. And then 2/3 of your contribution will go into the vesting pot. Now that can never, ever be withdrawn and has to be used to buy a life annuity when you eventually retire. So, but that's only from the money coming in from the 1st of September. 2/3 goes into the vesting pot, and if you resign, you cannot take it. You can take it, however, well, your beneficiaries can take it if you die, and you can take it if you are disabled. But if you resign or you fired, you cannot access that vesting pot. That's there for retirement. Now, for those of you who are relatively old, and by that I mean anybody over, let's say, 55, the whole two-pot system is hardly going to make any difference to you at all. It's really for the young people who have 20, 30, 40 years to go to retirement, where this is really going to have an effect. So it's not a short-term thing, it's a very, very long-term thing. And long-term, it should actually make our retirement system better than it is at the moment. And our retirement system in South Africa is probably one of the best in the world. Don't realize that our retirement, excuse me, our retirement funds are trillions and trillions of rands. The fact that we've got trillions of rands in our retirement funds is the fact that the rand isn't 100 to the dollar. If we hadn't had all that money in the retirement funds, that's what the situation would be. We're completely different from places like the UK, where their state-run pensions, their grants to pensioners, aren't paid out of accumulated money. They're paid out of the taxes that were taxed that year. So the problem with Europe is that all those countries there, except maybe Norway might be different, I'm not sure, but most of the countries in Europe actually have very little retirement savings. And the problem is now with the baby boomers all retiring, there are going to be huge draws on that. And that is paid out of the tax paid that year. Those benefits are paid out of that. And it's going to be a disaster for them. So if you have a South African pension, you're very, very lucky, because our pensions at least have some money behind them, unlike the pensions in most of the European countries, where the money really depends upon how much tax the government can drag out of the poor suffering taxpayer in that particular tax year. Okay, any questions at this stage? See no hands. Okay, so here are some things that we need to consider. So after the 1st of September, your savings pot essentially would be empty. So what they're going to do is they're going to put a bit of money into your savings pot, and it's going to be the lesser, notice the lesser, of 10% of your existing fund credit, or 30,000 rands. So if you've got 5 million in your fund, they're not going to put 500,000 in your savings pot. They are only going to put 30,000 in. If you've got 20,000 in your accumulated credit, they're only going to put 2,000 in. So that's to provide a little bit of money in the savings pot just to get things going. And remember, then after that, you will be putting in 1/3 every time a contribution is made. Okay, Kaylee, next one. Secondly, you may make only one withdrawal from your savings pot each tax year. That's from the 1st of March to the 28th or 29th of February, depending if it's a leap year. Only one withdrawal each tax year. Now, the reason for this is reasonably obvious. There's a lot of admin required for this. Pension funds are very, very strictly regulated and have to be very careful that they don't pay money to the wrong person and do the wrong thing, etc., etc. It can have very, very long-term adverse effects on the product provider, like Old Mutual, let's say, if they pay things incorrectly. So that means that the admin and the checking and the approvals and things like that are quite onerous. And they can't allow you to use your savings pot as a sort of a piggy bank that you can turn upside down and shake and get a few pennies out of it every time you feel you're short of a bit of money. So only once per tax year. Okay, Kaylee? Next, each withdrawal needs to be a minimum of 2,000 rands. Now, okay, I see a question from, who is it from, Kaylee? I missed that.
Willie van der Veen.
Oh, Willie. Yeah, Willie, these will apply to each and every retirement product that you have. So let's say you have a preservation fund from a previous job, and you have a pension fund at work, and you have a retirement annuity with Sanlam, and you have a retirement annuity with Liberty, and you have a retirement annuity with Old Mutual. It will apply to each and every one of them. So that lucky fellow can get 150, well, I don't know if he's lucky. That unlucky fellow can get 150,000 rands from his 5 different pension funds, pay a heck of a lot of tax on it, and cut his retirement benefits hugely. But it applies to each and every one. It's not like when you get taxed if you've got income from different sources, where SARS will put them all together and say, oh, okay, this person gets bank interest, and they get an annuity, and they get a pension, and they're actually doing a little bit of consulting work. We put all of this together and we tax them on the total amount. SARS has not done that in this case, and so for each and every retirement product you have, you're going to potentially have this. If you're over 55, you need to opt in for it. So each withdrawal needs to be a minimum of 2,000. And again, that is so that the product providers are not inundated with frivolous little claims. You know, I need 500 bucks for this, or I need 100 rand for that. Okay, next one. Now, we put this in red because it's this. Shakespeare says, there's the rub. This is what really makes it very, very unpleasant to draw money out of your savings pot, because each withdrawal will be taxed at your marginal tax rate. So in other words, if you take, let's say you've got 30,000 in your fund, in your savings pot, and you draw that 30,000, first of all, they're going to take some admin fees off that. I don't know, say 400 rand or so. So you're going to end up with 29,900 or 29,600 or whatever. But the full 30,000, including the fees, I should think, are going to be added on top of your salary and all your interest and all your other taxable income, and taxed at the very top rate that you fall into. So it could mean, I doubt, hopefully these people, sorry?
So it would be 13,000 tax.
Okay. Well, at 40%, at 40%, you'd pay 13,500. Kaylee's just done that little calculation for me. You'd pay 13,500 in tax. Certainly, some people might be at the 45% rate. So they would pay nearly half the money they draw in tax. Right, next one, Kaylee. I've already mentioned this. There will be an administrative fee for each withdrawal, which will be deducted from the amount you withdraw. And I think you're going to pay tax on that amount as well. We're not quite sure about that just at the moment. Okay, next. If you've already taken the withdrawal from your savings pot and resign in the same year, you will not be able to withdraw whatever is left in your savings pot unless it is less than 2,000. So that's another thing to regard, just little technical details about how it's going to be administered. Okay, let's see what's next. Okay, so Kaylee, is this going to work? Okay, sorry, we were going to do a poll, but we're not going to. But if you want to, you can unmute, put your cameras on or whatever, and say whether you were thinking of accessing your retirement savings before age 55. Nobody has the courage to unmute even.
Someone's typing. Yes.
Okay. Okay.
No.
No. Aviani says yes. Okay, so some people are now, remember, taxed at your marginal tax rate, eh? Okay, Kaylee, let's see the next one. Okay, Darren's, it's a no for me. Good. You obviously have a good financial advisor. Okay, so now let's look at an example. Right, so here's Savvy Sam. He's 25 and starts to work on the 1st of September 2024. So in other words, he's got no vested pot. He hasn't got anything that's going to be treated according to the old rules. So he starts on 1st of September 2024 and he's got a salary of 40,000 a month. He never ever draws from his savings pot. Next slide, Kaylee. And here's Spendthrift Steve. Oh, that's a bit of a mouthful. Spendthrift Steve. You can just see the money pouring out of his wallet. He's 25 and starts work on the 1st of September 24, just like Sam. Also the salary of 40,000 a month. But, you know, he needs money. You can see he's got nice clothes. That beard probably needs a lot of grooming and hairdos and all that type of thing. He's very much on show and keeping up with the Joneses, etc. And he regularly takes all the savings available to him. Right. Now, how do their retirement situations compare? First of all, let's look at the tax and fees paid. Now, this was based upon, I think, someone mentioned that if you owe money to SARS, SARS will very likely take the money out of any withdrawals you make. That's correct. We don't quite know how it's going to work so far as tax directives are concerned. And normally, before you can withdraw out of a pension fund, the product provider has to apply to apply to SARS to get a tax directive, and SARS will say, look, take this much tax off. It's an interim tax, and once we actually do the final tax at the end of the tax year, we will adjust that up or down or whatever. So the taxpayer may get a refund if they took too much tax, or may be subject to extra tax if they took too little. So we don't know if that's going to apply to these withdrawals from the savings amount. We'll have to check that. And again, things are very much in the air because legislation is still going through the process and being signed, etc., etc. Okay, so how do their situations compare? So Sam hasn't paid any taxes, no fees paid on withdrawals. But Spendthrift Steve has paid 275,000. Now that was worked. I worked this out on the basis of what tax you're paying on 40,000 a month. So he's paid 275,000 over to SARS, and to the product provider for the admin fees. So that means every year he's only, the money he's got after all the withdrawals of 558,000. Now, again, for this exercise, I removed inflation. So I said they ended up with a salary of 40,000 for the rest of their lives. Obviously, that doesn't happen. With inflation, hopefully, you know, it's 40,000 this year and 42,000 the year after, etc., etc. So you go up. But in order to, because we don't know what inflation is going to be, in order to make it all in today's money, I took inflation out of it, and I took all increases, salary increases out of it. And all I worked on for the growth in the pension fund was a growth in excess of inflation of 2 or 3%. I can't remember exactly what it was, but it was a reasonable amount. So Spendthrift Steve has had 558,000 to buy designer whiskey, designer clothes, designer car, designer house, or whatever. Then we come to the tax-free lump sums. Savvy Sam can draw his 550,000 tax-free, and he only draws 550,000. There's actually more in his savings pot than that, but he only draws the 550,000 because he doesn't want to pay any tax on lump sums. So he's got 550,000 now. So that buys the car at retirement. You know, when you need to downsize your car and get an automatic because you're getting old, etc., etc., or it pays off the bond, or just gives you a nice little nest egg to have sitting saved somewhere for any sort of emergencies. All Steve has is 67,000, which is when I did the spreadsheet to calculate all this, I only drew 30,000 a year. But remember, that 30,000 would have been growing in the savings pot. And so that 67,000 just represents a little bit of interest that was left behind, etc., etc. And that whole 67,000 will come out tax-free, because remember, those withdrawals that he made don't reduce the 550,000 that he's allowed to take tax-free, because they've already been taxed at a huge amount at marginal tax rate. So bad luck, you know. He's 483,000 short of what he could have taken. So maybe, yeah, 483,000 short of what he could have taken as a lump sum, tax-free, but it doesn't have it in his savings pot, so he can't take it. And Savvy Sam then says to his product provider, to Old Mutual or Liberty or Sanlam, whoever it is, and says, you know, I'm only taking 550,000 out of my savings pot. The rest of the money in my savings pot, please move to my retirement pot so that I can get a bigger pension. And he's going to buy a pension with that, together with his spouse, and it's going to be inflation linked. So this is, again, when you come to retire, you've got to get the best advice you can afford, because you can make so many mistakes. And unfortunately, your pension money will be the biggest amount of money you've ever handled in your life, very likely. And you have one soft decision to make, and if you make the wrong decision, bad luck. That is with you for life. Annuities, etc., can't be reversed. So he has actually consulted his financial advisor, and the financial advisor says, you know, with this amount of money, you could actually get 40,000 a month, but it'll never increase. Or you can include your wife and never increase it, you'll get 35,000 a month. Or you can include your wife and sacrifice income up front in order to get inflation linked increases going forward, but that you'll only get 21,800 a month. So that's in fact, that's in fact the best way to go about it, because it means that if you die before your wife, she continues to get the pension. If inflation is high like it was last year and the year before, then you're going to get a bigger increase in that particular year. So it means that your living standards are relatively stable. Okay, and Spendthrift Steve has no money to transfer from his savings pot to his retirement pot. He buys a similar sort of annuity as his friend, and he only gets 16,350 a month. So that's rather sad for him, but that's the cost of that. Now, that's a difference of what, 5,500 a month. But remember, that's 5,500 a month, 12 months of a year, potentially maybe for 30 years. Because you retire at 65, a lot of people live until 95. Nelson Mandela lived until 95. My father-in-law lived until 95. My father lived until 90. So people are living into their 90s. So 5,450, whatever it is, yeah, 5,450 less a month makes a big difference when you say, okay, he's going to be drawing this for 30 years times 12. That's 360. 360 times he's going to earn 5,000 more than the naughty boy who drew all his money along the way. Okay, Kaylee, next one. Okay, I don't know if anybody here is on the government employees pension fund or any other defined benefit fund. There are very few of those left now. Government employee pension fund is one of very, very few that are left. But on that fund, there would be a big, big difference as well. Oh, is somebody saying that they are on the government employees pension fund? Just let me know. I don't know who is this. This is
Brandon Reed.
Brandon, are you on the government employees pension fund? Well, okay. Yeah, you are. Okay. So if that's the case, the problem with the government employees pension fund is they've got a huge amount of money. They've got trillions invested by the public PRC, Public Investment Corporation. But there's no actual rand amount attached to each member because each member's benefit is determined by their years of service. So the way the legislation has got around this is, in fact, in your savings pot and your retirement pot, you don't have money, you have year service. And if you draw out of your savings pot, you essentially drawing year service. So when you come to retire, the way they work out your pension is your year service divided by 55. So if you've drawn everything out of your savings pot, it means that your year service is going to be reduced by 1/3. And therefore your pension, your gratuity, everything is going to be reduced. Government employees pension fund, you're still going to get a gratuity because there is not a savings pot really for government employees pension fund. Your gratuity is going to be less than if you didn't draw, and your pension is going to be much less. You can see there's a difference there of, what's that, 8,500. So it's going to make a huge difference if you're in a defined benefit fund such as the government employees pension fund. Okay, any other questions? Please just unmute yourself and ask. You don't even have to put on your cameras if you don't want to. No questions. Okay, so can we stop the presentation at that stage? Okay, so just a reminder that Kaylee and I offer other services. We offer risk cover, life insurance, disability cover, severe illness, and funeral cover. people often underestimate the importance of risk cover. It is actually very, very cheap, and it should be the first thing you do before you start saving, before you do retirement or whatever, is risk cover. Because if you have people that depend upon you for an income, it's no use you starting a savings and putting 1,000 rands a month in it, and 6 months down the line you get disabled or you die. So now you've got 6,000, lovely. But really what you want is 6 million. And that's what risk cover provides, and it's cheap. The other things we deal with are savings accounts, education savings, excuse me, tax-free savings, and retirement annuities. And we also do business assurance and pensions for business, pension for businesses. In fact, two of the people on this particular call are clients of ours, where we provide the pension at their work. So that's what we do. Any other questions? Any questions at this stage? Any comments? Any reactions? Okay, so can I? Okay, I see a couple of people clapping. If you do need to have any more information, or you'd like, just to ask a question, you don't want other people to hear it, please just contact us, and we will, we'll try our best to answer whatever questions you have. Other than that, I'll say good night, and thank you very much for attending.
Thank you, Val.
Thanks, Darren.